Recording. All right, well, this is the webinar on selecting stocks and option strategies. And I guess we can start this off by saying, well, what is the overall guiding philosophy around what we're doing here at Apple Investor? And the overall guiding philosophy is that we want to become uh, in the way we trade, kind of resilient, but more than resilient, more than robust. There's a term that Nassim Taleb uses called anti-fragile. And what that really means is that even in the face of adversity and the odds, um, the more difficult things get, the way you conduct yourself will make it easier, or you'll become, I guess, more effective even in the face of adversity. And the way we select things to trade, and the way we approach the strategies that we use and the size that we use is all designed around being anti-fragile. This isn't an anti-fragile webinar, but that is the overriding philosophy. So the other thing is that most everything that I'm going to be talking about is sort of geared around being on the other side of the trade, where most people are focused on buying things and trying to find the right strategy or the right time to get into something where price is going to run away and you're going to make lots of money. They're typically usually on the wrong side of things. And so what we do here is we want to be on the side of the people who are writing or selling those opportunities for other people to, I guess, fail. Uh, the fact of the matter is that most people that are trading are failing, and those are the people that are doing what everyone's telling them to do. Follow the trend, and so it's just craziness. That really I guess the overriding philosophy is that we are contrarians in the way we select stocks or things to trade, and the strategies that we choose to apply to them. So we're overall people who will favor selling things as opposed to buying things, um, trading small, trading often, so that no one trade or no one position can break us. And in fact, by trading this way, we can actually become, our positions and our approach can gain some strength from that. All right, so enough on philosophy, and why don't we get right to it? So I think I got to turn off. Let's see here. How do I turn this thing off? Making too much noise. All right. So selecting stocks and option strategies. Now, the room started out as clearly as a room that was focused on systems and automated systems, and letting a machine do most of the work for us. But you know, I've come through an epiphany, and I've been trading and using systems for a long time. In fact, even while a hedge fund manager, um, and they work great for a while, and then sometimes they don't work great. We need something that is more resilient, more anti-fragile, easier to do, more reliable. And so the first part of that process is figuring out what the hell you want to trade, and then how you're going to trade it. So this strategy is this webinar is actually comprised of two basic parts. And the first part is selecting the stock to trade, and the second part is going to be choosing the strategy to employ on those things that we select. All right, so why don't we get going? So The word underlying, you'll probably hear that a lot when you're trading. If you're trading options, I'm sure most of you understand what it means, and it's also used in derivatives trading. It refers to the thing that you're trading is what the thing is under the cover. So if you're trading an options contract, that is a derivative of a stock or a future or something, or it could be anything. Um, but the underlying is the thing that is actually being manipulated. And this whole the process, although you can make it rather mechanical, there is somewhat of an art to it, and there is some intuition that you can put into it, but it's largely built up of very very specific rules and thresholds that we want to meet first, and then everything else after that is your own personal preference. So in other words, if we're going to sell premium, if that's our main goal, then we want to figure out how to find stocks that have the most premium to sell. Um, but then after that, you'll have a lot of choices because there's 7,000, 8,000, 9,000 stocks out there to sell. And when you start whittling them down, to get the absolute best list, you might come down to a couple of hundred, but still that leaves a lot of choice. And so from that point of view, there's a lot of art because if everyone was following these rules, then everyone would be trading the same stuff. But they're not, obviously. So you trade what you like and what you know. I think that's important because you want to be in a place where things are comfortable and things that you understand. It's just easier for the brain to wrap around. Um, if you're into cars or if you're into technology or if you're into whatever it happens to be, that you trade what you like, and you'll be able to find stocks within that category of things that you understand to trade that will all meet the criteria that we're going to be talking about. And so what this really comes down to then is the other thing is that you want to make this as simple as possible. So you want to whittle it down to um, some core things that you watch on a regular basis, and you get really good at understanding how they behave. And so you want to build a list, and the more concise that list, the better. But it doesn't have to necessarily be stagnant or static. Um, you can have like a core list where you have your top 10 and maybe there's the bottom 10 that kind of float in and out, and maybe your top 10 might change over the course of a couple of years or a year or whatever, or based on seasonality. But you do want to build a list of things that you become very familiar with, and that list, it should include a mix of stocks and things that you like to trade, but it should also include, at a very least, everyone should include the indexes and some of the more prominent ETFs, um, only because they encompass much larger markets. They're more stable, and they have a lot of the characteristics of what we're looking for in our core list, in terms of size and so forth. Um, so that brings us to the what are the underlying criteria on how we actually choose what we want to trade. And we'll use, from a statistical point of view, we'll use some factors and some thresholds, but from a high level point of view, the most important thing is that we want things that are extremely liquid, that are easy to get in and get out. There's nothing worse than being in a trade that you can't get out, and the darn thing just keeps on going against you, and you know that if you could have gotten out, you would have profited, but now you're in a hole. And that really comes down to how liquid it is, how many shares are being traded, how many people are actually in there, interested parties that are going to be able to take the other side of the trade. And the other thing is price. Price is there's different thoughts around this, but in general, especially with options, it's a lot easier to trade things that have big price tags on them. There's more room to move, and it's just easier. So you can set some kind of threshold. You can say, geez, I won't trade anything under $30. And that's a good threshold. Um, but you'll find that the stocks that are up in the 50, 60, 70, 100, 150, 200, 500 are easier to trade than those that are $15, $10, $5. All right. So then the next big thing, and I'm not putting these in order. I'm saying that these things on this top line are all equally important. And well, I would say maybe from our general point of view, the way we our trading strategy, this next one is probably most important, and that's the implied volatility. There's two different types of volatility: this historic volatility and implied volatility. Historic volatility is exactly what that says. It's uh, the range of movement of a stock uh, that it has exhibited over a period of time, some defined period of time, a week, a day, a month, a year, whatever. Implied volatility is the range of movement that we expect that stock or security to move in the future, in the immediate future. All right. And well, I mean, that's really what we're talking about. I mean, we're not trading in the past. We're trading with things where we expect them to uh, go or behave. So implied volatility and liquidity are really our most important factors. And price you can use as a guideline. Now, IV rank or implied volatility rank is um, over the course of a year, a stock will exhibit a certain behavior of implied volatility. It will have a range, a historic range, as we go along. And the rank is so. Let's say that your range is 5 to 30. I'm just making up numbers. Well, if the current implied volatility of your thing is right smack dab in the middle of it, then your rank or your percentage is about 50%. What we're looking for are stocks to trade that are currently with an IV rank in the 65 percentile or better. So that means that in this period in time, right now, looking at their range over a period of a year, they are now more volatile, or at least in the top 35% of what they have exhibited in terms of volatility over the past year. So that's a guideline. That's a threshold that we use. We won't look at anything unless it is up there. Now, in up markets where things are really moving and everything's gaining, it's going to be hard to find stocks that have a an IV rank of 65 or better. In markets like today or yesterday, especially, or the day before, it's really easy to find stocks that have an IV rank above 65. As a matter of fact, it's easy to find them when they're above 90. And then it really comes down to, well, okay, then we just find the most liquid ones that are above 90 or 100 or whatever. So now the rest of this next one, the technical or relative strength or overall market conditions, that's pretty important too. But it's kind of ethereal and a little bit. That's where the art kind of comes in, um, where you can build a thesis around why something is behaving the way it is, and its relative strength to other things. So technicals can be very important, um, but you can find a reason to trade just about anything. So the technicals will help us um, sort of define or put kind of I don't know, a box around the types of strategies that we might be looking for, or the things that we're trying to group, or whatever. It's just a way to kind of group things. Um, we're also interested in these things that we call binary events. Now, binary events are events that we know will produce a lot of implied volatility. We know that stocks will move. that their price will move potentially drastically. And so we're very interested in those as well. And so besides, you may not find the stock that has a great IV rank, but you know that it has an event coming up. So for instance, a really good example of that is Apple. Right now, its IV rank is relatively meager, and it's hard to trade, um, from an options or option seller's point of view. There are certain things where it's easy to trade. You know, studies that we've done that have shown it to behave certain ways. But in terms of selling the premium in Apple, right now it's relatively cheap. It got better there for a bit, but it still didn't get up there. There are a lot of other stocks that were quite frankly better. But on the other hand, when Apple comes up to earnings, it's a different story. Or if there's a new upgrade or a new product announcement or whatever. So it's fleeting. It doesn't necessarily follow with the rest of the market. It has its own market. So we're interested in these binary events: earnings, dividends, product announcements. And then finally, when we're putting together all of these things to trade, they need to make sense in our overall portfolio of things that we're trading. So what that means is that you don't want to have too many things that are biased to the bullish side or too many things that are biased to the downside. Um, you want to have a good balance and things that complement one another. Otherwise, when market conditions change and you don't have a good handle on that, it's really difficult to make good choices because you're spending more time trying to fight a fire or trying to get things in line. So again, very important. The context is very important. Now, it seems like a lot, and that's why I said, there's no real, um, very very hard and fast rules that you can use. These are all kind of like guidelines that you take and learn and become experienced with. But if you follow some very, very simple guidelines and focus on just a few of these things, and I would say focus on implied volatility and liquidity, you're going to do really well. So, as I said, implied volatility, it is, in my view, the most important of the criteria. It tells of the expected move, what's going to happen, um, as opposed to what has happened in the past. And the other thing is that one thing that we'll learn as we're becoming more and more experienced with trading is that it's all kind of relative. It's not just its own implied volatility, but it's also in comparison to the market because um, depending on whether the market itself, its implied volatility is higher than relative to the stock, or the stock is higher to the market, we may choose different ways to play something. So how it relates to the market and other correlated products or other stocks within its genre is also important. So again, this is kind of redundant. This is what I'm giving a definition to what the IV rank is, or IV rank. The rank is where it lies within its range over the past year. The other thing is that we're also looking for things that have recently moved very sharply, right? So a good example of that in the past couple of days are stocks like Facebook or IBM that have moved drastically in the past few days. And um, there's always with that kind of move, there's always some level of reversion back to where it came from. So those also present particular opportunities. Now, the cool thing about what we're going to be talking about in terms of options, we don't care, um, exactly where it moves to. We just care that it moves, and as long as we can capture or put a box around that movement, we can make money. And of course, liquidity. Definitely looking for very liquid securities, um, things that are trading with lots of volume. Their pricing is going to be more efficient. You're going to have much tighter spreads. It'll be easier to get in and out, easier to get filled, and that means less slippage. So that when you actually take a trade, you're getting in at the place where you think that you're going to be getting in, not a dollar or two off. It reduces your risk and helps you put more definition on your overall assumption. So, in terms of options, the two things that you're going to be looking at are its overall volume and its open interest, and also looking at the underlying overall volume. Of course, that's where you would start. So, here I have sort of a made up scan list that we might look at and see what might look good as opposed to those things that might look not so good. So we can see that Kraft, eBay, Facebook, and Tesla, they all have that implied volatility, all the ones that are in green, that is near or above that 65% implied volatility level. This is exactly what we're looking for. And they have high volume, all right? As a general rule, we're looking for stocks that have a trading volume of greater than 2 million shares a day on average. You should get a pretty big list, maybe a few hundred that are trading 2 million or more a day. And then, of course, they are open interest. Um, if you go and look at the money call of any particular front month, you take a look at the open interest and compare that to others. That's just an indication of how many people are in there actually trading this thing, and whether or not you're going to be able to trade it with them. And then, of course, the bid-ask spread is very important too. There's nothing worse than trying to get a price and you can't get it within 50 cents. It's crazy. I mean, it could mean the difference between, profiting, a tick could mean the difference between, 50 or 100 or, $1,000. The tighter you can get that bid-ask spread, the more certainty that you're going to have in entering a position. So if you look at the ones in yellow, you can see that they are markedly different, and they're certainly off of our candidate list. And all right, so now I talked about binary events like earnings and other types of events. These are very important, and they will affect your selection on what you're going to trade. And there are some things that are going to be nothing more than earnings plays, and other things that are going to be because they're within a market or influenced by the overall market as being very highly volatile right now. Other things will be these binary events. They become volatile for uh, a very, very brief time, maybe hours or a day. So why do we care about high implied volatility? The reason why we care is that when things are extremely volatile, they increase the pricing or the premium that's put on the options that represent those securities. And that's really what it all comes down to. The more premium that there is, the more we can have more money potentially that we can make. All right, because in the strategy that we use, or the strategies that work, are the people who are the net sellers of premium, not the people who are looking to buy stuff. The people who are looking to buy stuff are usually looking for things that are cheap. Um, Unfortunately, those aren't the things that are usually making money. Um, Things that have high price, options that are priced high, the reason why they're priced high, and even above their intrinsic value, their underlying value, their time value, and their implied volatility value, um, those are the things that have a higher probability of ending up at or near expiration in the money or worth something. All right. So I'd rather be dealing with the things that are potentially going to be or have a much greater chance of being worth something than not. And so that really is a direct reflection on implied volatility. And that's why it's so important. We're looking for things that have lots of premium because we can sell the premium. And what's most important about this, and what really makes a net seller of options so effective, someone who can make money whether their stock goes up, down, or stays the same, as opposed to the buyer who can only make money in one direction. A seller of options can make money in all directions or no direction. All right. But it all comes down to how much implied volatility there is to inject premium into the things that they're going to sell. And what they're really looking for is the the property of options that decay as they get closer to expiration. That's how they make their money, by having lots of premium that will then decay away. And um, that decay actually is what goes into our pockets as net sellers. It's a fundamental concept. That's what it's all about. It's about getting lots of premium and using the decay of that premium to our advantage. And the only way you can use it to your advantage is if you are a net seller. So this is a little bit contrarian to the way most people think. Most people are thinking, you buy with the trend, and buy high, buy low, sell high. The problem is that they're always getting in a little bit too late, too little, too late. Um, and as a general rule, what people don't understand is that what we're taught is to sort of buy into things that are going up and go with the trend, which is exactly the wrong thing to do. What you really need to do is be selling into strength and buying into price weakness. The whole idea is that you're trying to get ahead of the curve. You're you're buying into volatility. You're selling this volatility because you know that later on, after that, you get that huge surge in volatility, that later it's going to contract. And when it contracts, that's the decay. And the more you can pump it up, the faster it's going to contract. Or the more it gets pumped up, the faster it will contract, and the more money you will make. So that's what it's all about. So this is the end of the first part. We're selecting very liquid stocks. We're going to rank them by their implied volatility. And we're always looking for these two things: the pop rock, the greatest probability of profit, and the most return on our capital. So we want to put on trades that are cheap but profitable. So you got to find that balance. And as a general rule, one thing I said earlier is that you want to trade really small and a lot. Um, when you would think that, geez, if I can find the most profitable option out there, why don't I just load up on that? Well, that is not the anti-fragile way. That's the extremely fragile way. Because if it goes against you, it can go against you bad. You can find a lot of little things and put tiny little trades on all over the place and take up very, very little capital. and all of them can be really highly profitable with a high potential for profitability and be very, very cheap. And it really comes down to your ability to shop for them. And that's what it is. It's, being a wise shopper. If you're a wise shopper and you put on lots of tiny little trades and then you just manage that flow, you're going to make a lot more money and it's going to come easily. So what I'm showing here is a screenshot of the Thinkorswim platform and showing a scan that I created and ranking, scanning by these criteria. And you can see the IV percentile, implied volatility, and volume. Really looking for that IV percentile and volume. Those are the most important things. All right. And you're going to pretty much see the same 100, 200 stocks that are always going to be at the top of these lists. And so from those, you choose what you find or what you find most comfortable. All right. So once you've chosen your list, then it really comes down to, what are your strategies going to be? And you're going to find that there's going to be a few strategies that you'll be using more often than not. And they'll all be kind of grouped in the neutral to neutral bullish or to the neutral bearish category. Because those are the ones that are generally the ones that are, the credit spreads or the condors or the flies and so forth. Those are the ones that are going to allow you to be the net seller. But there's other ways to play all this stuff too. There are other very interesting things like covered calls or covered puts or other strategies. But the implied volatility is going to be the driver for both the selection of the stock or the option and the strategy. All right. And our overall objective is to match our risk capacity and tolerance and to build, I keep on coming back on this, build our anti-fragility makeup. We have to become as vibrant and flexible as possible. And the best way to do that is to have a lot of little trades that are highly profitable with a great return on capital. So I can tell you that the most successful traders aren't trading huge lots. They're trading tiny little lots, but they're trading a lot of them. So the other thing I had mentioned earlier was a market implied volatility versus the stock implied volatility, and that will you're constantly looking at that. Which, from a relative point of view, has more implied volatility, the market or the stock, and that's going to lead you to a strategy that is maybe more geared towards a stock or more geared towards an index ETF, for instance, or maybe just playing the VIX. So you're constantly looking at that, you know. So excuse me. So a market implied volatility that's low relative to the stock will lead you to selling stock premium strategy, and a market implied volatility that's high relative to the stock will lead you to a market premium strategy. In other words, maybe playing the diamonds or the SPY or the QQQ. So some of these strategies that you're going to see over and over, and even in our room, I think in the last this past week, we've really sold mostly iron condors. We did a broken wing fly, and a covered put. But these are the strategies you're going to see over and over and over again. And at first, maybe when you were first learning options, these are the ones that were maybe they appeared to be more exotic. but in fact, they are they are the fundamental building blocks of um, being a net seller. So iron condors, butterflies, broken wing flies, which are nothing more than a unbalanced butterfly, and credit spreads, and then of course covered calls or covered puts, naked puts, strangles. Um, all of these, if you choose wisely, have a very, very, very good return on capital. They're really cheap to put on. So you can find, in general, most of these, you can find, a return on capital of 50, 100, 200%. That's what you're looking for. And if you can put on a bunch of these that are really small, it's going to make you more resilient, more anti-fragile. So of course, we can't always count on volatility always being there. Uh, but even in low volatility markets, we can still find those choices that are of the highest volatility nature. But selling premium obviously is more difficult in those thinner markets. And by being more anti-fragile, by playing smaller, it's going to help you weather those markets much easier. So you trade smaller more often, you widen your strikes, and you focus on only those stocks with the high volatility. Maybe you only look for when you have these type of markets, this low volatility market, you look for more of these binary events. So you're more selective and looking for that criteria. And when you're in one of those markets, and you have to put on something that will take advantage of the low volatility market, you want to protect against a sudden rise in volatility because that can kill you. So you want to be smart enough to be able to put on something that will allow you to morph into these other strategies that you saw a couple slides ago, that that are your bread and butter. So by looking at directional diagonals and various types of diagonals and directional trades, straddle strangle swaps, for instance, um, and put spreads. Those are the types of things that you're going to look in for low volatility markets, because they can morph into the type of things that you're looking for. Particularly things like a straddle strangle swap. Um, it can be used in neutral environments, and it benefits as volatility rises. And it's cool because as volatility rises, you can adjust the trade and maybe turn it into a double diagonal, and then eventually into an iron condor. And you can start out with what looks like uh, little or no volatility, no premium, and just keep on building on the trade and rolling and turning into something that rolls with and absorbs any volatility that happens to rise. So you're constantly looking to morph and gravitate towards the volatility. You're gonna and again, that's sort of the whole anti-fragile concept, that you you want to benefit from things that look more highly volatile, that look riskier, and you get stronger by using a strategy that works better in riskier environments. And I know that sounds contrarian, but that's the key. And I suggest, I tell everybody that's in our room that they should read Nassim Taleb's book on anti-fragile, and also read his other books too, like The Black Swan. And it's an excellent treatise on what being anti-fragile really means, and it's really important to be a successful options trader. So we're getting near to the end here, and this is my overall conclusion. You're trying to scan and sort your stocks based on implied volatility and liquidity. You're employing strategies that exploit that volatility and a change in volatility, like the binary events. You want to trade small and often. That makes you anti-fragile. It makes you so that you're impervious. As a matter of fact, you do better by things that are riskier and tougher environments. And you within those type of environments, you can maximize your return on capital and only concentrate on those things that have the highest probability of profiting. And as a general rule, what you want to do is you want to sort of target your profitability of profiting on all your trades at somewhere around 65 to 75%, which is unusually high for what most people think is a traditional approach where they're trying to get to 40 or 50% and then try to make it up in money management. Here we're looking for that sweet spot of 65 to 75%. The interesting thing is if you try to go too much over that, if you try to go for the 100%, your the amount of return that you get on capital starts diminishing quickly. So it's just again another guideline that you use that we target. All right. Well, that's the presentation. I don't know if there are any questions. Let's see. Is it possible to download these slides after the? Yes, I will. I will be taking the video from this, and I'm going to edit it down, and then I'll put it on the website under the video section, and under that will be the slide that you can download. Please show the list again. So you aren't recommending a higher chance of probability. No, what I'm recommending is what is proven to be the right amount of probability. There's, it's kind of like the law of diminishing returns. When, you know, when I say that, you can do better by widening your the wings of your spreads, right? But well, then you say, well, geez, if I just make my iron condors big enough so that they encompass the entire market, then I can't lose. Well, unfortunately, there's a limit to how wide you can make these neutral strategies to encompass all possible strikes. After a while, your commissions and other things um, diminish the potential return. So we found that the ideal place to choose, and there are also guidelines that we use when you're actually putting on a credit spread. You want your credit spreads um, to be about the return to be about 1/3 the width of the spread. These are critical factors that these guidelines that actually point us to what is the optimal. There are optimal numbers that we use. So the 65 to 75% is kind of an optimized um, target that you shoot for, and it's not a hard target to shoot for. It's easy to do this. It's just that if you go much beyond that, then you get diminished returns. I mean, to say always stay under 75%, sometimes you can, sometimes you can't, but that's the goal. These are guidelines. These aren't, hard and fast rules. So you're trying to hit that sweet spot as often as you can. Yeah, 1/3, a meaningful return. But that's what you're shooting for on these spreads, um, as a general rule. Now there are some strategies that obviously they have the potential to return quite a bit more than that, but it really depends on the strategy that you're using. There are a whole range of rules and guidelines that we use that help kind of focus us in on hitting that nut. Yeah, I guess you could say that. Yes, for a spread 1K premium, it should be at least 300, $400. Yes. No, actually, it's not. It's quite easy. Um, just takes a little bit of work and knowing where to look and how to find them. But usually, by just employing some basic strategies, you're going to fall right on top of them every time. All right. Well, thank you very much for attending the webinar. Um, the for those of you that aren't members of the Apple Investor Trade Room, we if you would like to try it out, we have a 100% money back guarantee. Uh, Come in and hang out with us. Uh, see what it's uh, see what it's all about. I'm sorry, I'm a little tired. I was up all night having brain fart. Thanks, Julie. All right, guys. Thanks again for attending. I'm going to turn off the recording now.